Hello class, this is the second video of the PowerPoint demonstration on Treasury Stock. Treasury Stock is common stock that's already been issued that the company purchases back. Basics of accounting for Treasury Stock. Treasury Stock account has a normal balance of debit. Treasury Stock is a contra equity account. So it's contra equity account to the common shares at par. Treasury stock is recorded at cost, which is similar to its par. It'll be issued back out at cost without reference to par value. So the cost in itself becomes like a par value. Treasury stock account is reported beneath retained earnings on the balance sheet as a reduction of equity. And again, a company will buy back treasury stock if they believe that the stock, their current value, market value of common stock on the market is undervalued. So they'll buy it back because they feel it's less than what their value is of the stock. And by buying back treasury stock, it signals the shareholders that they believe that their stock is undervalued. So it kind of spurs the economy to buy the stock. It triggers a sale of stock. Also, treasury stock is purchased back at a lower price than what they believe it is because they'll be issuing it back to CEOs, CFOs, higher end managers in the corporation as bonuses. So, Smart Touch Learning purchases $1,000 shares of previously issued common stock, paying $5 per share. So that's the cost per share times 1,000 shares. That's the treasury stock, which comes back in. It's a contra equity account, and they paid out $5,000 cash to purchase the treasury stock. Then they, in turn, sell 100 shares of treasury stock on April 1st for $5 per share. Okay, so there's no premium or discount here. They're selling it for what they paid for it. So they receive $500 cash, and it's treasury stock common, $5 per share times 100 shares, so that'll be credited. So here's the $5,000 they bought at $5 per share, and $500 for the sale of 100 shares. When you're doing your T accounts, I tend to put in what the cost was here. So I would put in $5 listed above this, so I know for further information how much the cost was of that common stock. Then Smart Touch Learning resells $200 of its treasury shares for $6 per share on April 2nd. Recall that the cost was $5 per share, so we have a premium of $1 per share. So we're selling it out, $6 per share for 200 shares. That's going to be the cash, $1,200. It's our debit. We're going to credit treasury stock common at $5 per share at its cost for 200 shares, so it's at $1,000. And then we'll have paid in capital from treasury stock for $1 per share, 200 shares for $200. So now you can see the paid in capital from treasury stock transactions. So this is an excessive cost. Okay, so this is a premium that people paid, and we'll keep track on that. If we sell it as a discount, it'll come out the debit side. Right now, this is the credit side, which is the normal balance side. On April 3rd, Smart Touch Learning sells 200 shares of treasury stock for $4.30 per share. We paid $5 per share, so keep that in mind. The cash, $4.30 per share times 200 shares, we received $860. The treasury stock is going to be issued back out at $5 per share at its cost, so that's $1,000. So the difference between the two is $140 or 70 cents per share. This is paid in capital treasury stock, 70 cents per share times 200. Now notice that the $500 or the $1,000, it gets issued at $1,000 here, comes out of Treasury stock at cost, but we take it out because it was at a discount. We take that $140 out of paid-in capital Treasury stock from the premium we had before. So now we have a balance of $60 in a paid-in capital Treasury stock transaction. This is an excessive cost, and we've issued out $3,500 worth of shares, and we have $2,500 left. 2,500 shares at, well, not 2,500 shares, but divided by 5. So that leaves us at $2,500 at $5 per share, 500 shares left to issue. And then what happens if Smart Touch Learning sells an additional 200 shares Treasury stock for $4.50 each on April 1st. So again, we sold it at a discount again. We'll be issuing the Treasury stock at $5 per share times 200 shares, 1,000. Okay. The cash, $4.50 times the 200 shares, comes out to 900. Okay. We sold it out as a discount, so we have to take the balance, what's would be owed, which is $100 out of paid-in capital Treasury stock, but we only have $60 left in paid-in capital Treasury stock from the premium prior to. So we take that $60 out, and the deficit, the $40 deficit, comes out of retained earnings. So there's no longer a balance in Treasury stock paid-in capital excessive cost. So that is a zero balance. The $40 we were short, that debit will come out of retained earnings. So now we're down to 1,500 shares left. $1,500 left, or 300 shares. So this is what it would look like on the balance sheet, partial. We have the preferred stock, $50 par, 2,000 shares authorized, 1,000 shares issued and outstanding at 50,000. Paid-in capital excessive par preferred, 5,000. Common stock, $1 par, 20 million shares authorized, 23,000 shares issued, 22,700 shares outstanding. Now the difference between those, that 300 shares, are the shares that are in Treasury stock. So this is the total, like we've seen before. The total we have available for issue is 20 million. We have 23,000 shares issued, and we only have 22,700 shares outstanding because there's 300 shares still left in the Treasury stock. If we were to issue a dividend to common stockholders, the stockholders that would be issued, that would be just 22,700, because we can't pay ourselves a dividend on Treasury stock. We have paid-in capital excessive par common, 25,000. Total paid-in capital, 103,000. Retained earnings, 3,510. And common stock, Treasury common stock, 300 shares. So it's showing we have $1,500, 300 shares at $5 par, or cost, still in the equity account.